This is AHL Explains. I'm Anthony Ledford, and today I'll be explaining signal diversification. Today we're going to look at signal diversification, which, like all diversification, is about boosting the amount of return you obtain for each unit of risk that you deploy. Now, there's a huge number of different signals we could include here, so it's important to stress that we're only covering a very small subset. We're really just scratching the surface. And out of what we discussed, CTA managers or managed futures managers, they will typically have a high allocation to momentum. So the non-momentum strategies in their case should be thought of as small complements to their main momentum signal. In contrast, if you have multi-strat managers, then they will be able to allocate broadly across all of the styles we'll go on to discuss. Okay, so where are we going to start? Well, we haven't really explored momentum yet in its entirety. So let's have a look at what else is in there. Well, we've done trend filters, and those can be thought of as trend lines along the previous price history. But there are also breakout systems which are widely used. Now, the idea of a breakout system is to identify key price levels such that if the price goes up through one of those levels or goes down through one of those levels, that will generate buying or selling. Also in this category, I'd include curve momentum, which is something that's applied in fixed income. And this is a slow momentum predictor that also combines information from the yield curve structure. Alongside those momentum systems, we can also include technical systems. And the first of these I would include is spreads. So instead of going long or short an individual contract, what you're aiming to do here is to track and forecast the difference between two contracts. So for example, if I draw this curve here, and this is my first contract, I might go long on this one and I might go short this one, then what I would be looking to trade is the difference in vertical height between these two contracts. Well, you can extend that idea further into something called a butterfly trade, where instead of using two contracts, you use three, and you would go long the outside ones and you'd go short the one in the middle. The idea of this trade is that if you think of those 3 points as sitting on some curve, then as that curve gets exaggerated away from its equilibrium behavior, it will tend to move back towards the equilibrium. And that's what's being traded here. It's the curvature of the underlying curve between those three trades and how it should revert into its equilibrium state. This is an example of a mean reversion type strategy. Again, it's going to provide diversification because it's not simply following an individual contract. Another type of trading to include in this technical category is volatility trading. To understand that, think of a situation when prices are range bound. That's exactly when your momentum systems on price are going to struggle because the prices are neither going up nor going down. But associated with those times is also that the volatility tends to be in decline. So even though there's no trend on the price, there is a trend in the volatility, and capturing that volatility trend is where the profit comes from here. Finally, I'll include fundamentals. And to understand why a strategy would go into this category, think of it as capturing information that's outside the price of the underlying asset. Probably the most important fundamental predictor is FX carry, and this is something that's been widely written about in the academic literature. Now, the idea of FX carry is to take two currencies, one with a high interest rate and one with a low interest rate, and you go long the one with the high interest rate and you fund that position by borrowing in the currency with the low interest rate and then using the FX exchange to make the currency transfer. Now, the reason so much academic literature has been written on this is that the forward FX rates don't tend to move in a way that neutralizes the interest rate differential that you've picked up at the start. Another type of carry we could include here is commodity carry, and we've seen something of this already when we looked at futures and we looked at the gold curve, and we saw that gold futures prices were driven to some degree by storage costs and interest rates. Well, being long or short a gold contract is going to expose you to these predictable effects that come through from the storage cost or the interest rates, and you can build strategies around that. The final thing I want to mention is inventories. Now, if you want a tangible example of this, you can think of something like copper. And there are various warehouses around the world which publish the amount of copper they have stored in them. And this copper is going to be the copper that is available to come onto the market. And basically, if there's a lot of copper coming onto the market, you know the price is probably going to be going downwards. Whereas if copper is going to be scarce, you know that there is going to be more of a premium associated with it, and the price would probably escalate. So those really are the three blocks of different style systems that you can think of in terms of how you can diversify your signal. As I've said, the majority of trend followers will have their investment signal concentrated in the momentum space, but alongside that, they will produce some diversification by having exposure into these technical or fundamental systems. Okay, that's all I'm going to say today. The next thing we're going to be looking at is a different style of momentum, which is cross-sectional momentum. Thanks very much.